Good afternoon, and thank you so much for joining us today for our webinar on the 2023 forecast. My name is Abel Delgado. I am the Digital Marketing Director for America's Market Intelligence, and I'm going to be serving as today's moderator. So before we get started, we just want to give you a quick idea of what to expect today. We're going to have about 50 minutes or so of presentation and then 10 minutes for questions. But of course, we'll stay online and answer as many questions as we possibly can, meaning that if those 10 minutes go by and we're more questions to answer, we'll certainly do that, and we'll stay on the line if you were on the line and answer those questions. One of the big questions we always get, are the materials going to be available afterwards? And the answer to that, I'll give that to you in advance, is yes, absolutely. What we do is usually within a day or so of the webinar, we edit the video and then we send these presentation slides along with the video to everyone who is registered for the webinar itself. So you definitely will receive those materials. The other thing that we're going to do this year is actually add sort of an appendix, because our practice leaders put together a lot of great data. It's just that it would be a lot to add to this particular presentation today, and it would make us go over. So what we're going to do is add that data as sort of an appendix to the presentation slides, meaning that you'll not only get today's presentation that was made live, but also a bunch of fresh new data. All right, so let's move on here and look at our other sections of the webinar itself. This is our legal notice, which I encourage you to read at your leisure. This is something I'm not going to read off, but take a look at it when you can. It just covers a lot of issues in terms of liability and such. Now, who we are as a company. So we're doing this forecast because as a company, America's Market Intelligence has been around for 30 years doing market intelligence in a variety of sectors for Latin America. So over that time, we've accumulated a great deal of experience in these areas. And that's really what's fueling the forecast today. And the analysis that we do right up until this point, working with our clients, is really what's fueling what you're going to hear about today in the webinar. So this gives you a quick overview of who we are and what we've done. One of the most notable things is 30 years of experience studying the region, and also something like 4,000 projects completed in that time frame. In terms of what we do with these actual projects. So what we focus on with our projects is helping our clients in terms of understanding the market in a variety of different ways. Basically, we focus on customer, competitor, and context, but really it's all about helping our clients make better decisions, strategically informed decisions, so that they can be successful in Latin America. This is a quick look at some of the clients that we've served over the past years with all of these studies that we mentioned. And now this brings us to our presenters. So basically leading us off is going to be John Price, the Managing Director of AMI. And then our other speakers are going to include Lindsay Lear from our payments practice, Alejandro Alvarez from our mining practice, Arthur Deacon from our energy practice, Diego Rodriguez from our logistics practice. And of course, I'm going to be serving as the moderator. Now, this is a poll question that you're seeing up here. So before we get started, we would like to poll you. So I'm going to launch that poll now. The screen is just sort of shows the poll itself, but I'm going to actually launch it so you can participate, and you'll be able to see that now take up your screen. So what we'd like to find out here with this particular poll is, what kind of growth do you expect for your Latin American business in 2023? And so we offer a variety of different options, and we'd like to see what your thoughts are. All right, getting some very good participation here. All right, so we're going to close out the poll now, and we're going to share those results real quick so you can sort of see them on there. So it looks like there's some really good optimism here. That the biggest response, of course, is between 5 and 14% growth. That's 37% of you believe that you're going to have that kind of growth in 2023. But then you have 15 to 30% growth. 24% of you believe that. So that's also fairly robust. And then, of course, we have 10% thinking greater than 30%, which good for you. We're really glad to see that. And it's actually helpful to see and heartening to see that 9% only think there's 0 to negative 10% growth for 2023, and only 4% say less than negative 10% growth. So thank you so much for letting us know about that. And let's move on to the next stage of the presentation to lead us off into the actual forecast. And for that, I'm going to turn the floor over to John Price to get us started. John.
Thank you, Abel, and thank you everyone for responding to that poll. It certainly was pleasantly surprising. We are often surrounded by news at this particular point in time that's negative and has people worrying about what's going on next year. So that was refreshing to see. As Abel points out, we are taking a slightly different approach this year, combining both the traditional economic and political forecasts that I'll roll through in the next few minutes, as well as a I think probably more importantly, a trend analysis that will be introduced by Lindsay Lear and commented on by all of us here. And we're hoping that the combination, this sort of different combination or different approach to our forecast will prove more useful and more practical to your business planning efforts. So on the next slide, you'll see that we have forecast, and when I say we, it's actually the Economist Intelligence Unit with some input from ourselves. Two different lines here. One line, the red one, are the growth figures that you're accustomed to reading. This is what they call real growth. But when you convert it to dollars, and for most of you, that's actually more relevant because your businesses are measured in dollars, you'll see that the next 2 years will continue to see fairly robust growth, 6% a year, which reflects very much what your survey results just indicated. Now, why the difference between that 6% and say the 1.5% real growth that you're probably seeing in most publications? Well, it comes back to down to the fact that Latin American currencies are holding up well. And let's explore a little bit about that. Let's move to the next slide. First of all, there's two drivers in the Latin American economy externally that have very short-term effects on the economy. And this all stems from the fact that in Latin America, because of the lack of confidence in the rule of law, in the government, and in our economies per se, so much Latin American savings is kept offshore. And that means they have to borrow, usually in dollars, whether it's government or corporations. And to service that debt, the most important way of doing that is the surplus trade of exports. And although, of commodities. And although we have had declining commodity prices in the last 2 months, we had a massive increase over the first half of the year. And as a result, commodity prices on average over this year are well above those of the previous years. And even though they may continue to soften, they will remain high by historical standards. Now, this is driven by two things. One, the fact that we went out and printed a lot of money during COVID that stimulated a lot of demand, and also the fact that the Russian invasion of Ukraine, which was followed by a combination of sanctions as well as Russia's own turning off of the tap of certain energy supplies, has taken a lot of commodities supply out of the market, which of course always drives up prices. And Latin America, or some Latin American countries, are benefiting from that. Let's look at the next slide, particularly at the energy sector. So in the energy sector, you'll see that the countries that are net exporters of energy, this is traditionally oil and gas. Countries like Venezuela and Colombia are the ones that grew fastest this year. And the countries that are net importers, like Brazil and Mexico, had much more moderated growth. So as long as we have elevated energy prices, there is a real material impact in Latin America. And the fact that OPEC doubled down on cuts announced yesterday, we should see a continued relatively elevated pricing certainly in oil. On the next slide, we'll get into our analysis of interest rates. And I'm going to come across as a bit wonky at this point, but if you can imagine, and I think everybody's aware of the fact that when the US federal bank raises interest rates, then money rushes into the United States, into treasury bills and other bond assets. And that takes money out of other markets and tends to elevate the dollar and weaken other currencies. But thanks to the very able management of monetary policy in Latin America, led by its independent central banks, these central banks took a step ahead of the curve back 9-10 months ago and began to aggressively raise interest rates. And that has slowed the drive of money from Latin America to the United States. And on the next slide, you'll see what the immediate impact has been. While the British pound, the Japanese yen, the euro, and even the Chinese renminbi have suffered this year versus the dollar, Latin American currencies have held their own. And that, again, is the foresight of the central banks in Latin America that aggressively raised rates ahead of the Fed, whereas these other markets were slow to react with their raising of interest rates. It's kind of ironic because these countries are supposed to have a very independent central bank, but it turns out that they were quite susceptible to political pressures versus the more independently operating Latin American central banks. Let's move forward. Here you'll see that this is not just a one-off. This is not just a 2022 phenomena, that in fact, the effective exchange rates, that is the purchasing power of exchange rates. In other words, in these countries, the exchange rates look like they've dropped. The Colombian peso is a much higher number versus to the dollar versus where it was before the pandemic, but wages continue to rise in Latin America. And so what is the acquisition power of your customers in Latin America? Well, it turns out that they're fully recovered in some of the biggest markets and are recovering in almost all of the major markets in Latin America. A lot of you have expressed to me in conversations that you're trying to lower expectations about your growth because customers are more price sensitive in Latin America. Well, this shows just the opposite, that in fact their purchasing power is recovering. Let's move on. There's a lot of numbers here, and so let me pick on a couple of storylines that I think are interesting. First of all, in pink, you'll see that in 2020, this is net imports. In 2020, the imports of Latin America collectively dropped over $150 billion. But the following year, in 2021, they more than recovered. They leapt $300 billion. So we've seen a real recovery in trade. And in fact, when we look forward next year, most people have baked in certainly a recession in Europe and probably a recession in the United States. Why? Because the aggressivity with which the Fed is raising the rates will take the air out of certain high growth, capital intensive industries like startups, like technology, like the housing market. But there's no reason to think that we're in for a long recession. Why? Because the average American household is healthy, relatively low debt. The average corporation in the United States is still healthy with lots of cash on its balance sheets. And the government of the United States, its debt levels as a percentage of GDP have actually been dropping during this inflationary period. So we will have a recession in the US. It will be short-lived. And Mexico is the most closely correlated economy, will suffer the most. Brazil has made amazing reforms over the last 4 years, thanks to Paulo Guedes and an accommodating Congress that's being pro-business in its makeup. And that has engendered a lot of investment, and that will begin to produce demand for imports over the next years. Okay, let's move on. A lot of people talk about the political ramifications of COVID and the fact that the region is turning left. Well, that's because Latin America performs so poorly vis-a-vis other parts of the world in its management of COVID, and these statistics bear that out. So let's look at a map of Latin America on the next page and see how the region shifted. The region has not universally shifted left, but it has universally embraced change. And some of that change has been to the right in the blue, and some of it has been to the left in the red, and some of it we're not sure, or there's a mixture. For instance, Lula might win the presidency, but the Congress he will rule over is very much center-right. So it's really about change and not about a pendulum shift one way or the other. In summary, on the last slide, I'd like to point out some of the, we've talked about the strengths and weaknesses, some of the opportunities. Well, if you're targeting businesses in Latin America, focus on export industries. Like any coming out of a recession in Latin America, exports are leading the way, and it's no different this time. E-commerce is here to stay and continues to grow. And now we're seeing e-commerce being adopted universally across all cities and all regions. And we've got markets that were often neglected now looking interesting again because of the oil boom. The threats, we're still seeing capital leaving markets like Chile, Peru, and Colombia because of the changes in governments. And we're seeing profitable sectors being targeted for higher taxation. So with that, I'll end my comments and pass it back to you, Abel, to walk us through the next poll question.
Thanks so much, John. So let's launch that now. This is where we're asking you about long-term trends. So we have a series of long-term trends here, and we're asking you which of these long-term trends do you feel will most impact your Latin American business over the next 5 years? And we have a variety of choices here: digital disruption, sustainability, resource scarcity and optimization, interoperability and interdependence, digital democratization of business opportunities, or other. So let's try to get those in. These are the ones that will be focused on mostly in our presentation, actually. So we'd like to see, how in line our thinking is with yours. And so by all means, let us know what you think. All right, we're getting some really good participation. And this one does take a little bit of time to answer. So we're giving you some extra time at this point in time. It's a lot to think about. Long-term trends is a tricky business. All right, wow, there's some really great participation in this poll. We are at well over 70%. So I think that we can probably share the results now, and we will. So if you take a look at this, most people think that digital disruption is going to be the biggest problem. They're at 26%, or the one with the most impact, so to speak, not so much the biggest problem. And then, of course, we have resource scarcity optimization at 24%. So that's sort of in second place. And then we have digital democratization at 19%, sustainability at 14%, interoperability at 7%, and other. It'll be interesting to see what that actually means. And of course, you can share that with us in questions in the question section as we go on. So, all right. Thank you so much. Let's keep this moving along. And now I'm going to turn the floor over to Lindsay Lear, the director of our payments practice, to go over some leading trends analysis. Lindsay.
Thank you, Abel. Good afternoon, everyone. Great to see so many of you here. I'm pleased to introduce the next section of our webinar. If we go ahead onto the next slide. For those of you who have been to our annual forecast webinars before, you know that each year our aim is to help businesses across all industries prepare for what's ahead and identify key threats and opportunities. And so when we sat down to prepare this event, we took a step back. And we realized that our industry practices really cover the full span of the economy, from the consumer economy, you have some examples there, to the B2B and productive economy, to the extractive economy. And what we wanted to do was bring you some insights and some intelligence that will help you navigate what's to come, no matter what industry you're in. And so the poll gave you a little bit of a sample what we're going to be covering today, but we identified 5 key trends that will impact business leaders across the region, with digital disruption being this mega umbrella trend, which was the leading trend that is going to be impacting most of you, which encapsulates 4 additional trends: sustainability, optimization, interdependence, and democratization. So our plan and what's remaining of the webinar today is to first define these trends for you, but also drill down into specific threats and opportunities by industry and implications to help you understand and help guide your decision-making in the next 12 months and even beyond that. Okay, so with that, looking forward to this discussion. I'll turn it back over to John to lead us through our first trend.
Thank you, Lindsay. As you pointed out, digital disruption is this sort of umbrella trend. And in fact, we all, if we were to poll people here, we'd all probably have our own interpretation of what it means. But where it comes from, or what's been the driver of that, is the fact that 75% of urban Latin American adults possess a smartphone today. And that has really provided a marketplace for massive change in consumer behavior, and which has spawned so many different disruptive businesses and allowed businesses to disrupt very effectively. Whereas in so many business ideas that have been introduced to Latin America in the past, they've only impacted the top sort of 15% of consumers. With so many people possessing a smartphone, it really has had a widespread impact. So with that, I'd like to turn back to Lindsay and ask you, Lindsay, looking into the short and medium term, what do you think will be the next consumer behaviors to become digitized? And what do you expect to be the next implications of evolving digital disruption?
Thanks, John. I get this question a lot, and really with the majority of adults having access to the internet through a smartphone, this really puts the power the voice into consumers' hands. And more so than what are the new habits to be digitized, I really think it's about consolidating behaviors that have been experimented with. This has been the most experimentational time for consumers with a whole variety of new options available to them. So there are four key areas or pillars that we saw kind of begin to take place, which will start to be consolidated in the next year. So P2P and money transfers being the first ones. And we're going to start to see new verticals like paying for a doctor's visit or recurring transfers, even the financing of transfers become new opportunities going forward. Crypto. Crypto has taken the region by storm right now, according to AMI polls. More than 30% of smartphone holders in the largest 6 markets have experimented with crypto. And we expect with the pace of acceleration, we expect this to go over 50% in the next 12 months. And so the very first low-hanging fruit there is capturing those cash-ins when consumers go to fund their crypto wallet. That's a new payment flow that's never been seen before and is accelerating. And there's competition between local exchanges and international exchanges. So there's a great opportunity there. New lending models, including buy now, pay later. This has been experimented with heavily in the past 12 months and is going to continue to consolidate. We need better access to credit scoring to really help these players succeed. And it really drills down to the question, who is going to be the best at converting debit card holders and bank account holders to credit? You know, we have only over 150 million account holders who don't have a credit card. So major opportunity there. And then in e-commerce, this is the most consolidated vertical of these 4, but we still have some leading retailers and marketplaces growing more than 100% in their online business in 2022, particularly in Brazil. So that speaks to a still under-penetrated opportunity, if you can believe it. And really, I think a major trigger there is going to be having an optimized omni-channel strategy that incorporates desktop, mobile app, mobile browser, social media, click and collect, cash on delivery, and even thinking further down the line, sales within metaverse and other types of virtual reality platforms. So to summarize, none of these behaviors are consolidated yet. We're kind of in a free throw opportunity for companies to grab these new behaviors and really loyalize customers as these behaviors consolidate.
You know, what's so interesting about that is that the pandemic was not a blip, and that we're not seeing a sort of slowdown in growth, but in fact, it was almost, it widened the participating pool of players, small business, consumers, et cetera, that weren't part of that digital economy. And now they're really waking up to the opportunities.
Absolutely.
Diego, as logistics director, you know, given what Lindsay just said about e-commerce, I can only imagine that the logistics industry is also being upended. Can you enlighten us on that?
Sure, John. Thanks for your question. I think when we think about the pandemic and all the digital innovation that occurred in Latin America, definitely we saw an accelerating pace. And with the overization of the entire logistics cycle in the region, we now see how all the investments, infrastructure investments that private companies, retailers, logistics firms were pushed to perform as a result of the rapid growth of e-commerce. We expect to see that in the next 12 to 24 months in Latin America, a massive adoption of digital platforms, digital solutions to utilize and to improve the efficiency of those assets that were built, and that all the money that was invested in e-commerce and the industrial and logistics space will be underutilized, considering the economic slowdown at the global level and in the region as well. So when we think about digital innovation, we are seeing companies looking into platforms that can offer them the availability to tap into third-party assets, to move cargo at faster speeds, to reduce cost. And when we look at the inflationary environment in which we are right now, those 2 elements, or those 3 elements that I just mentioned, become critical for any legacy logistics player. And the digitization trend that we're seeing is not only happening on ground transportation services, but it's occurring on ocean, air, rail. And now the trend that we're seeing in Latin America is how booking services are becoming digitized. And one of the best examples is LATAM Airlines. I think that gives a lot of initiatives and ideas for other companies that are looking into the digitization of the booking of their services, and how today LATAM is able to offer the same experience or a similar experience as booking commercial flights in the case of air freight, offering real-time pricing and availability. That's a great opportunity for companies in Latin America as they will struggle in terms of finding efficiencies in the assets that they have right now. And lastly, I like to touch upon one key element, and it's the fact that digitization is helping to expand the way that logistics firms tap into new markets, small and medium segments, when in the past companies were focused exclusively on the large shipper segment. Now with the economic slowdown, new opportunities through digitization are emerging in that specific space.
Thanks, Diego. I think it's fascinating that so many of these smaller logistics players, particularly in fulfillment, were able to rush into the marketplace, and the big legacy players were slow. But now the legacy players understand that it's a big enough market, a juicy enough market, that they need to play there as well. And I think the fight for the middle and smaller player customers will be a really interesting battleground over the next couple of years. Switching gears a little bit, Alejandro, most people don't give much thought to how a smartphone in the hands of millions of isolated rural and semi-rural Latin Americans has changed the investment climate of the region's oldest industry, mining. Can you enlighten us on this?
Yes, John, this is a great example of how these trends are transversal to all industries, and it helps showcase AMI's deep breadth of consulting capabilities spanning beyond market research. In the past, miners have relied on national governments to quell disruptions, often with heavy-handed policing by the army. But today, smartphones and social media provide a public relations weapon for local communities that are mounting protests, strikes, and roadblocks. To give you an example, this year, as part of a protest, local communities occupied company land in Peru's Las Bambas copper mine, which caused it to suspend operations. Communities blocked the road along which the ore is transported, and the event was broadcasted across social media and counted with the support of NGOs, international NGOs, who bring proven fighting tactics. In a period when national governments across Latin America suffer from record low approval levels, few leaders are willing to risk political capital to quell a local protest that interrupts a mine. Local community opposition campaigns have had serious consequences this year for mining interests in Peru and Honduras, to name a few examples, which are set to continue in 2023. We advise miners not to hitch their reputation wagon to national governments. Reputation in this industry doesn't come from customers, but from stakeholders. In the foreseeable future, miners will look to actively engage with communities in social media and online platforms and make use of an untapped opportunity to address concerns in real time and with potentially greater level of detail. So in short, in this age of digital democracy, the old ways of doing things are really not safe from disruption, regardless of industry.
Great, thank you, Alejandro. Yeah, I think that it's not just about your customers, it's about your stakeholders, and the fact that digitization gives them all a much bigger voice, and all businesses have to be conscious of that. Okay, let's move on to the second trend, which we've defined as sustainability. And sustainability, if you ask anyone around the world what it means, most people will mimic the definition of how it was formed in Europe and some other parts of the world, like California or Japan, as really a sort of voter consciousness driven idea that I'm going to change the way I behave, I'm going to change the way I consume because I'm worried about the environment. But as sustainability has been practiced in terms of policymaking, in terms of business behavior, in Latin America at least, it's more about optimizing or cutting costs on resources. So using less packaging material to save costs, using fewer or more efficient sources of energy to save costs. And so it's important that we listen to our panel and see how they perceive Latin America defining sustainability and how they see it impacting these industries. Because again, I think what we perceive as a universal definition of sustainability is not in fact how it's practiced region by region. So with that in mind, I'd like to ask Arthur. Arthur, AMI recently published a white paper called Latin America Getting to Net Zero that you authored. Is Latin America's energy mix getting greener? Can you give us a forecast of green energy and where the biggest opportunities and challenges lie?
Yeah, for sure. Thank you, John. Always a pleasure to be here and happy to see so many of our colleagues, participants in this call. So the energy matrix is definitely getting greener. There's no doubt about that. And that's led mostly by Brazil and Chile. But when we exclude hydropower, which is a major source of electricity generation in Latin America, when we exclude hydropower, Latin America has actually the lowest adoption of renewables among all global regions, except for Africa. So this creates a major opportunity for renewables such as wind and solar projects to grow exponentially. And we see a particular opportunity in distributed generation, which we'll talk about a little bit more later. But looking ahead to the next 5 years, there are 5 additional opportunities that we'd like to outline within this energy transition. So the first one, and many of you have probably heard this over and over again, is green hydrogen. But it's not all green hydrogen use cases that will be successful. We believe that only the ones that directly replace gray hydrogen and are used to produce derivatives such as green ammonia or methanol for exportation specifically are the ones that will succeed. Hydrogen used for domestic heating or long-haul transportation are likely to see losses. Number 2 are renewable fuels, and that includes biodiesel, includes sustainable aviation fuel. They will see a relatively low consumption locally, but companies can take advantage of Latin America's domestic feedstocks, like used cooking oil and animal fat, to create a very substantial export market. So we see that export-focused products are the most likely to succeed in Latin America. Another important trend or opportunity that we see is battery storage. We're still very in the early stages in terms of regulation for battery storage. Chile is likely to approve legislation in the next couple of months, and that's going to lead to an exponential growth in Chile, followed by Brazil and other countries as soon as they adopt legislation. Another trend is underdeveloped and congested transmission grids. So companies such as Eaton and Schneider and Emerson, for example, that can provide services and equipments that improve not only energy efficiency, but also lower energy demand and improve the grid overall, will likely to come out on top. And then the last opportunity that we see is regarding EVs. And we're not talking about manufacturing electric vehicles, but mostly developing the EV charging infrastructure. Penetration of EV sales is still very low, well below 1% of total light vehicles sold last year were EVs. So there's a massive opportunity there, and we see Brazil, Colombia, and Chile leading the way. Each of these opportunities have specific challenges. There's community opposition to hydrogen generated by wind turbines in the south of Chile, where locals are worried about the turbines killing birds, for example. But broader challenges are mostly regulatory and political. But this anti-incumbent wave is actually more in favor of green energy than some of their predecessors. So that's a positive sign. We do expect governments to continue to struggle to balance their budgets. So oil and gas assets and their royalties will likely remain relevant in Latin America through the mid-2030s, regardless of who's in power. But we do think that these assets should be built what we call transition ready. So meaning that they can operate and transport lower carbon fuels such as biogas and hydrogen. And I'd just like to finish by saying that the energy transition is not really an opportunity just for energy companies. It's a transformation of all companies in any sector you can think about, and it will influence what your clients buy and what they don't buy. So I believe that it would be a massive oversight to overlook the impacts of sustainability on your business.
Great, thank you, Arthur. I want to point out that in the chat mode, if you open up your chat box, Abel has put on there a couple of links, one to the net zero white paper that Arthur authored that has been widely read, and also a more recent report on electric mobility. So please click through to those, download them. I think you'll find them useful. Diego, I wanted to ask you, sustainability is also a big issue in both industry and transportation. How are you seeing these industries responding to the pressures of sustainability?
That's a great question, John, because when we think about logistics in Latin America and the infrastructure that is in place and the investments allocated for the transition and for the reduction of the carbon footprint are very small at the moment. But when we focus the conversation on the following three topics that I like to mention, how the region will transition towards less impactful fuels and the incentives that the governments will put in place, I think there are opportunities. And the first one that comes to my mind is, let's think about the impact of rising diesel and fuel costs in Latin America. Because right now, diesel costs are artificially low in several countries. Because if we remember, there were recent protests in Panama, in Peru, in Argentina, in Ecuador, and those protests delayed government action to phase out the subsidies that are in place. And considering the budgetary constraints that governments are experiencing in Latin America, one of the key elements that logistics operators and challenges that we'll face in 2023 will be greater fuel cost across several markets, especially when we consider that elections in Brazil are about to get decided. In Colombia, the same. We have a new president. So we will start to see fuel costs move up, and that will accelerate the transition and the modernization of some of the old fleets. When we think about Mexico, Colombia, Brazil, the average age of the fleets are above 15 years, in some cases 20 years. So that will facilitate the transition towards more efficient vehicles if we think about natural gas and the incentives that gas-rich countries will put in place to accelerate the transition for commercial purposes. That's very important. And that's something that operational managers need to start thinking about. It's not so much about electric fleets, because that's way ahead that's way behind in Latin America. But when we think about new ways in which last mile can be performed with electric cargo bicycles or with bicycles and moving the last mile delivery at a localized neighborhood level, in which the miles traveled are shortened with the use of promising models with decentralized distribution hubs, thinking about how route optimization can reduce cost, I think it's the next frontier in the industry. Thinking about how to reduce those operational costs will be the key element that companies need to start considering for the next 24 months.
Great. Diego, I think that's a great example of how the virtues of sustainability and the practical need for cost saving, for time saving, they very much align. And this is why we think, even if consumer consciousness levels in Latin America, or rather their priorities, don't put sustainability at the top of the list, business nonetheless, and the actions they take and the decisions they take do align, because they are interested in lowering costs. And another area of lowering costs is our next trend, and that's really about optimization. You know, so many new business models have been brought to market to take advantage of idle assets. Your house that sits empty when you're away for 3 months of the year, your car that sits idle, just costing you money. These were the genesis of Airbnb and Uber. And in Latin America, the degree of asset inefficiency because of lack of technology penetration, because of the capital costs of innovation, because of government regulations, has generally been more inefficient than other parts of the world. And so when 75% of people were armed with a digital phone and these models were brought in, that's why they were so successful. And we're seeing such disruption around the optimization of assets. And it is now in a world of high energy costs, in a world of high commodity prices, in a world of more expensive labor in parts of the world, we're seeing an even greater push towards optimization. So with that in mind, Lindsay, disintermediation is a scary word for many in the payments industry and an exciting word for others. What do you expect to happen in terms of disintermediation, considering the rise of instant payments, of crypto, and other disruptive technologies?
Great question, John. Thank you. And this question of optimization, it really has to do with eating away big margins. Companies, when they have a fat margin, that is the competition's opportunity. And so we still see high costs, long wait times, and poor user experiences across the payments industry. And disintermediation is a word that we hear all the time, and it causes a lot of anxiety. And so I get the question, what is going to be disintermediated? Will this be successful? We've already seen huge disruption with Pix. I've heard many people say Pix is the most disruptive phenomenon. For those of you, the real-time ACH mobile transfer platform established by the Central Bank of Brazil has taken Brazil by storm and has mostly so far cannibalized cash, but is and will cannibalize other digital payment flows. And so this, along with other closed loop networks trying to disintermediate the banks and the card networks, along with crypto, this is the ethos of crypto, is to disintermediate the entire financial system as we know it. So these are forces actively in play right now. Now, what instant transfers have gotten so much attention in the past year for being very successful and for bringing a better user experience, for lowering costs and just improving payments overall. However, there is an elephant in the room that no one is really speaking to, and that is the lack of value-added services that these platforms have. They haven't been around long enough to embed the technology required to fully secure these transactions and make them sustainable over the long term. And that's what the card networks have done an excellent job at over the past several decades. Now, they need to innovate in terms of becoming competitive with these new systems that are really excellent in terms of user experience and costs. But there will be opportunity in the very short term, I think, as Pix and other instant transfer systems continue to succeed in building in these value-added technologies such as fraud tools, assistance with chargebacks and refunds, like an irreversibility insurance, reconciliation tools, recurring payments, and credit. These are all layers of the payments industry that instant transfers do not have yet, that have been really successful in other areas of the industry. And so that is big opportunity there to improve these new systems. It will, however, necessarily increase the cost of instant transfers. And so probably not going to be free forever. And there will be a balancing act that will take place between cost and the technology required to ensure the sustainability of these platforms.
Great, thanks. You've touched on a really interesting point. We are now entering a phase where for the last 5 years, there's been a lot of money pursuing bad ideas in sort of the startup world. A lot of overspending on startups, and a lot of startups that their operating costs were so high that they were actually operating a loss and just eating into the base of financing that they've received.
Burning cash.
Burning cash. And so going forward, they're not going to be able to burn that cash because the cash isn't going to be as available. And so this is going to create another shakeout in the marketplace. And this idea of efficiency, of competitiveness, of those players that have enjoyed fat margins for so long, lowering their pricing to be more competitive, but also these new disruptive players having to raise their prices to cover their cost. It's going to be a very interesting battleground.
And consumers don't like when that happens. They get addicted to the free
Right.
service.
Sure.
Then you have attrition and you have new opportunities. So really interesting.
Exactly. So Diego, let me ask you, what is driving optimization in logistics and industrial supply chains? And do these trends favor Latin America?
John, I think this question connects a lot with the first trend with digital disruption, because when we connect the way that, again, companies will have to optimize their assets from warehouses to trucks, ships, the region is about to experience a rapid shift to optimize those assets, specifically to cut cost in times and because we're under squeezing profits. So regional economies will start to slow down, not only Latin America, but globally. And because of the massive investments that we have seen in retail companies, logistics firms, we will see the optimization trend using digital platforms. If we go back again, how it connects with the sustainability, route and fuel optimization. I just discussed that. Artificial intelligence, the connection of APIs, that's something that we will discuss further down the line. But optimization, I believe, it's the key element that connects the different trends, specifically in the logistics and industrial space. And when we look at firms moving production facilities to Mexico, to Central America, the nearshoring trend, it is based on optimization because labor costs have been rising in China. Ocean and logistics rates have been also increasing after the pandemic. Now they're coming down, but it's still above pre-pandemic levels, and that is driving the optimization trend in Latin America. Definitely the region is well positioned to take advantage of the nearshoring opportunity, specifically Mexico and Panama as well, Colombia. It represents great opportunities, but that's where we see the next 12 months in terms of finding the best strategies to utilize those assets that might be underutilized.
Great, that makes a lot of sense. Let's move on to the next trend, which we're calling interdependence. If you're in the payments world, it's really interoperability. But we chose interdependence because it has a wider spectrum of applications. And really, I want you to think about it in these terms. Digital disruption and all of the new competitors that it has created has generally created competitors that have a narrower scope of operations. Now, there are exceptions. Amazon and Mercado Libre are two highly vertically integrated players who become even more vertically integrated with time, buying logistics assets and the such. But generally speaking, most of the new competitors in the digital landscape tend to be very narrow. And so they cannot operate without relying on the partnerships of others. Some of these partners might also be clients. Some of them might also be competitors in some occasions. But it has opened up the need to share technologies, to make technologies and how they communicate with each other in a digital landscape interoperable, so that new customers, new suppliers, and affiliate companies can easily join in. And this has really changed the mindset in Latin America, where people were very jealous, typically, of sharing technology secrets and IP, and tended to work in a more siloed fashion with very strong players monopolizing certain industries. So this is as much a change in mindset as it is in operations. But I'd like to, at this point, I'd like to ask, I believe it's Lindsay, about what, Arthur, this notion of interdependence can it bring more efficiency to Latin America's notoriously inefficient energy market?
Thank you, John. Yeah, very good intro there. I think interdependence has so many different factors to it. So it's important to think of this in a holistic mindset. So I briefly mentioned this earlier, but I think the greatest example of interdependence in the energy sector is the explosion of distributed generation. And that's because of subsidies and fiscal incentives, as well as lower cost of technology that has allowed many players to generate their own solar energy and sell the surplus to the market for a credit or direct compensation. And that is leading to more efficiency in terms of how consumers produce and consume energy. We foresee major growth in this distributed generation sector in smaller markets that are just now introducing net metering regulations, which allows consumers to sell back to the grid. And this includes Puerto Rico, Panama, for example, and Costa Rica. There's many larger markets that have been the ones that have set the pace in recent years, and that's Brazil and Chile, that are phasing out these subsidies. But there's still attractive opportunities in certain states within those countries. And then one outlier, when we're thinking about renewable energy, nobody's really thinking about Mexico these days because of confrontational policies, etc. But distributed generation in specific has done really well in Mexico because these projects don't need generation permits and are approved really quickly, which is a stark comparison from utility scale projects in the country. We also think that new regulations will lead to more growth in the free market, which is known as the unregulated market. This means that all types of players, no matter their size, will be able to choose who, how, and where they buy their energy from and sell their energy. So creates a much more open market. In Brazil, for example, the free market grew 20% in the last year. And with new legislation expected after this year's elections, this growth will likely more than double next year. Another important part of interdependence is energy storage. So energy storage, as I mentioned, still needs a lot of regulation and a decrease in costs to make it more attractive. But once those are in place, batteries will allow even more customers to sell energy back to the grid. And this will eliminate some of the grid inertia that is often very costly. So that means having backup coal or gas power to make up for the intermittency of renewables. So with these batteries, it will make users less dependent on centralized fossil fuel-based generation facilities, such as gas or coal, which are often very costly. So we expect lower energy bills for consumers in the future. And just conclusion, in terms of challenges, the free market can lead to the elimination of middlemen and other legacy players, such as distribution companies, who may end up with excess energy capacity due to their shrinking regulated consumer base. They have little room to adjust prices for their regulated customers, which makes their power less competitive in comparison to the unregulated market. So these players will have to rethink their business models to remain relevant. And that's something that many of these middlemen have to consider moving forward.
That's really interesting how, these more deregulated markets where the private sector plays a bigger role, how much faster they're moving towards these new models. It's really going to make a mark in the next few years in those markets that don't move so quickly. Diego, it seems to me that so much of the disruption in the logistics industry is really all about interdependence. Would you agree with that?
I agree, definitely, John, with that assessment. And when I think about interoperability, interdependence, I think what is really exciting about Latin America, it's the different options that cargo owners, shippers are starting to have, because we're seeing the emergence of logistics marketplaces, and we're seeing more price transparency than ever, and that is creating more competition. So I believe that interoperability is a great opportunity for logistics companies to arrive into this new digital era that we're seeing in Latin America. Because actually, when we look at startups, examples of companies that have disrupted the logistics space in the region. We think about Logi, CargoX, Newport. Those companies have created a lot of transparency that did not exist in the logistics space in Latin America. So I believe there are plenty of opportunities for software logistics providers offering open source platforms and offering solutions, not only for cargo owners, but also for logistics companies that want to take it to the next level. But in terms of threats, we are also seeing the emergence of security gaps, security threats. And we're recently, not to name companies, but we're seeing maritime firms being exposed because of the security breaches that we have seen in their system. So even though that there are plenty of opportunities and disruptions and innovations, I think legacy logistics players need to start thinking about the startups that could become potential acquisition targets in Latin America, how they can bring on new culture, new ways to disrupt, and new ways to find the next frontier that we are just starting to see in the interoperability realm.
You know, Diego, you raise a really interesting point. A lot of legacy players in all industries have looked at envy as they saw these startups get a lot of attention and massive valuations based upon either negative cash flow or very small margins, demanding huge. But a lot of these companies never went public. They're still in private hands. But now as cash dries up, you're going to see those valuations plummet. And that's going to open up. But at the same time, they're still disruptive. They still have great technologies and they've learned good business practices. But they're going to be a lot easier to acquire on behalf of these big legacy players who want to make a leap and are struggling to do it with their own internal resources. So I think you're going to see a very interesting acquisition climate in the next 12 to 24 months as a result of that.
Definitely.
We want to touch on the last trend, and that's what we're calling democratization, which is really about leveling the playing field. Technology gives consumers, small business, and key stakeholders who never had a voice before, or the barriers to entry were so enormous that they really couldn't make an impact, but they are now. And collectively, and those apps that collectively bring these people together and give them negotiating power is really giving them a voice. So I want to ask Lindsay, do you see the playing field leveling in payments and e-commerce as a result of tech enablement?
Definitely. As we've talked about, we've seen costs come down. We've seen barriers to entry come down, but only part of the way. There's still major work to be done. And I think one of the biggest opportunities here is being enabled by open banking, and banking as a service, which basically enables any company to offer banking and financial services. And this is already introducing new business models, new fee structures, new types of services that are empowering consumers in new ways. Doc, the fintech Doc based in Brazil, their motto is tech your business free, meaning, operating as a technology company, but enabling financial services. And that's really what it's all about. And we're going to start seeing unlikely suspects start to offer financial services, including convenience stores, gas stations, pharmacies, who interact with consumers much more regularly than any financial institution, and even more regularly sometimes than an app on your phone for certain segments of the population. So there's still a lot to be disrupted and democratized in services for the bottom of the pyramid, including remittances, services for small businesses. We've talked a lot about PIX, and that type of money transfer revolution has mostly impacted Brazil and other markets, but to a much lesser extent. And so that is still kind of an open playing field for reducing costs in merchant payment acceptance and moving money. And this concept of moving money in and out, pay-ins and payouts, is still where there's a lot of room for improvement. And things like open banking, things like these new payment ecosystems with reduced costs are going to continue to help that. The big kind of opportunity that we haven't really chipped away at really successfully yet is small business, where cash is still the number one payment method. So that's where I think the next frontier is.
Great. Thank you, Lindsay. Alejandro, earlier on, we talked about digital disruption, putting cell phones in the hands of rural communities near the mines and giving them a voice. One of the areas of their greatest grievances has been the lack of economic gains to these local communities in employment and other things. Does the democratization of technology access have any, chance of changing that?
Right. So, John, to our viewers, 3 months ago, we unveiled the Latin America Mining Risk Index, which is a quantification of 7 risks specifically applicable to mining in Latin America. And I encourage everyone in this call to go into our website and download it free of charge. But one of the 7 risks quantified was operational risk, which is not related to engineering challenges, but among other above ground factors, to the lack of local suppliers and trained employees, which raises operating costs and leads to friction with local communities. And technology plays a key role in connecting miners with locals. We advise miners in that a powerful tool for winning local support is to make a strong commitment to purchasing from local vendors. Local vendors, along with employees, become credible advocates of a project and help defend the miners' interests in the local community. Going into 2023, miners will be looking to restructure their procurement systems to both measure their reliance on suppliers from abroad and measure their business with local suppliers, which will require investments in effective cost tracking technologies that allows for management to monitor these indicators in real time. For example, Bolivian communities have long expressed concerns about the industry not providing sufficient training and education to allow them to develop and grow organically with miners. Now that it is widely accepted that Bolivia holds the world's largest lithium reserves, miners may benefit from rerouting some of the benefits from sky-high mineral prices to local training and developments. So, in short, miners will be forced to diversify their supply chains, and how and where to do it is precisely what AMI can provide good advice into.
Great. Thanks, Alejandro. And again, a reminder to the audience, in the chat mode, we've uploaded links to several of our beefier thought leadership pieces, including the mining risk index report that Alejandro mentioned. I also want to remind everybody that we're going to remain online to answer questions. And without further ado, I want to pass it to Lindsay, who's going to help summarize these trends and translate them into what they mean for opportunities for your businesses.
Thanks, John. And so we've delivered a lot of content and ideas to you all. And just to wrap up today's session, I want to drill down in some key highlights just so you have something really concrete to walk away with. To recap, we've touched on how these 5 trends impact the consumer economy, the B2B economy, and the extractive economy. So in the consumer economy, we're about 2/3 or 3/4 of the way through a very disruptive period that was triggered by COVID. More than 50% of Latin Americans, sometimes more than 80%, have already made a digital transaction. And really, the internet and the smartphone have empowered consumers more than ever. And we're seeing this empowerment not only have, of course, major implications in the consumer economy, but have a ripple effect into the B2B economy and the extractive economy. So as John said, being aware and conscious of our stakeholders, even if they're not our direct client, can help us navigate what we're experiencing in the next year. So in the consumer economy, I think the main takeaway I would touch on is that loyalty, we've never had more options for consumers. Costs are coming down, wait times are coming down, user experiences is improving, and as a result, loyalty is deteriorating. And so right now, things are very much up in the air. Traditional loyalty brand relationships have been disrupted, and there is an entire segment of the population who have only just begun their digital journey, and they're really wide open to whoever is going to best serve them. And so this is really about capturing and developing new relationships with consumers. And my opinion is it needs to take place at the use case level. Okay, there's no longer one bank or one retailer or one marketplace or one brand that's going to fill all of a consumer's needs. It really comes down to specific use cases and the most ideal product market match. And competing along those lines, I think, will help companies be successful. On the B2B side, the small business has been historically neglected in Latin America, okay? And with this new digital power that end users are wielding, we've seen marketplace and platform models be very successful. And there's continued room to grow there and continued room to improve accessibility for pymes, for small business, and empowering them to make an even bigger, small business represents over 90% of employment, but only 40 to 40% of the GDP. So I think that balance can be shifted through these innovative models. For big companies, large business corporations, and legacy players, they've been slower to digitize and innovate because of their legacy systems are so deeply integrated with their operations. But as Diego pointed out several times, this is starting to change through API infrastructure, through more open types of partnership and relationships, through optimization that speeds up processes and lowers costs. So suppliers to incumbent companies can really help them navigate these digital changes that consumers are experiencing and better respond to their customers, and as such maintain their market share. In the extractive economy, the mining industry, as Alejandro mentioned, has been notoriously bad at engaging with local communities, and local communities are more engaged and empowered than ever through technology. And so considering really who your stakeholders are and what the other levers that you need to be pulling to be successful is really important, and making sure that you're connecting and making an impact and branding in such a way that's going to have a positive influence on your investment and guarantee success. And in the energy industry, as Arthur mentioned several times, energy has been excessively inefficient in Latin America, and it is a very disruptible industry right now. However, a lot of roadblocks there, thanks to government interests and tax generation that is extracted from these industries. And so again, keeping in mind stakeholders, government engagement is really required to be able to push forward in this sense. So thank you, everyone, for staying on and for tuning in. We're really eager to get to your questions. But first, we're going to move into a very quick and last poll here. We want to engage with you one-on-one. Okay, we're here for an hour delivering our latest thought leadership to you, but we want to know what your response to this presentation is. What types of questions are on your mind? And so we would love to engage with you on a one-on-one basis, in either informally or in a formal annual business planning or strategic planning session. We do these 10 to 15 times per year with our clients. And so, please let us know if you'd like us to reach out to you to explore that opportunity. Go ahead and take a moment to answer that poll. And, you can request a consultation with any of the practice leaders, as well as John Price, for a one-on-one consultation just to learn more, and or to potentially plan a formal presentation to your business leaders. Give everyone a couple of last seconds to answer that. And then we'll move on to our Q&A. We still have a great crowd with us. All right. Abel, how are we doing? There we go. All right. Thank you, everyone, for your response. We'll be in touch with those of you who selected that and indicated you'd be interested in that. So moving right into our Q&A, I'll turn it back over to Abel to moderate this section.
Thanks so much, Lindsay. All right, let's go over a couple of these questions here. One of our first ones here is from Dan. He's asking us he's basically saying COVID had impact on trade. So he's asking us if we think that LAC trade trends will be strongly impacted by deteriorating geopolitical events such as China and Russia versus the West and India in the middle, given the elections and energy alliances, et cetera. So he wants to get our take on that.
It's a big question. Generally speaking, trade is not that impacted by politics. Trade is impacted by demand and supply and the price of products. Investment flows tend to be much more impacted by politics. Generally speaking, the tensions that you're talking about, the Russia, we've already commented on, and the impact it's had on rising costs of commodities. In China, everybody should be listening in, or at least reading the analysis of what goes on next week or the week after, October 16th to 18th, when the 20th Chinese Communist Party Congress meets and reelects Xi Jinping, and also determines the future of a few other leaders around him, some of whom are very much reformist and progressive, and others that are very conservative. And reading the tea leaves on those announcements will be really important. Most people believe that Xi Jinping has been holding on to zero COVID to get reelected, because so much of his legitimacy was tied to China's enviably low infection rates and death rates. But the fact is that if he's going to make policy changes over the next 5 years, he's going to have to get through COVID first. And so we're going to see a loosening of COVID. And we think that the domestic economy in China will grow again. It will actually shrink this year. The overall economy will grow, but that's because of exports. The domestic economy is actually shrinking. So we think there'll be actually an interesting counterweight to the slowdown in the US and Europe by virtue of a growing domestic demand in China. Over $400 billion of additional savings went into the pockets of Chinese this year, and they've got nowhere to spend it because of COVID. So we're going to see more spending in China next year, and that's going to be a positive for Latin America.
So more or less the same effect that we experience in the US, with a lot of money, a lot of spending in consumer goods, also spending in services as well. So Latin America will definitely benefit if Xi Jinping relax its zero COVID strategy, which is very likely, as you mentioned, John.
Yeah, I think so.
All right, thanks so much. So this question, I think, is relevant for Arthur. It's from Alexandra. She's basically asking on sustainability of the consumer economy, rather than having the onus on individuals, are there movements to target investment and subsidies to fossil fuel companies, such as to reduce tax breaks to them or divestment campaigns on university campuses?
Yeah, thank you for the question. Yeah, it's a tricky spot that governments find themselves in, because they do want to, the ones that are recently being elected and have policies in favor of a greener energy mix, want to decrease dependence on oil and gas and coal, etc. But as we see in Colombia, the moment that they try to increase taxes on those industries, there's a huge backlash. The bills don't make sense. It doesn't close. So in Colombia, they've had to backtrack some of those taxes and are decreasing it substantially. So even though there is this pressure to go green worldwide, we don't see any taxes being imposed in a substantial scale in the oil and gas companies, because the matter of the fact is that governments are still struggling to balance their budgets, and they're very, very heavily dependent on oil and coal and gas revenue. So it's a tricky balance between the two, but we don't see any of that happening in the short term.
All right, thanks so much. So we have one here that's more in the payment sectors, from Randall Douglas. His question is, you mentioned slow adoption of SMEs of digital payments and financing. What are the options or possibilities for moving or accelerating SMEs towards this trend? I'm in the Caribbean, so SMEs matter for many of the small island economies.
Thank you, Randall, for the question. And Caribbean is always a real tough geography. simply because they haven't experienced the fintech revolution that other large economies have. What we've seen what I've observed that has really activated small business is free and instant payment acceptance. Now, that's not a great business model in the short term, but platforms like Pix in Brazil, Sinpe Móvil in Costa Rica, Yapi in Panama are great examples. Now, two of those are orchestrated by the central bank, and one of those is orchestrated by one bank in particular, a leading bank, Banco General in Panama. Yape in Peru, as well as Plin, are also in this category. And look, small businesses are only going to adopt a digital payment when they see benefit in it. And that benefit comes from being able to attract more customers. So when your customers are consistently asking you, can I pay with Pix or can I pay with Yapi? That's really the only incentive that a company has to accept digital payments. When you risk having to pay higher taxes, not having cash on hand to pay your suppliers, and just having to adopt and understand a new payment system. And so these platforms being free or much lower cost than free in some cases and much lower cost than traditional card acceptance, very easy, and I receive the funds instantly. Those are the ingredients that have made these very successful. Now, this has only happened really in the past year, despite multiple initiatives from many fintechs and many service providers. And I've seen this have the most impact on SME digitization. In the long term, it's not sustainable. You have to monetize it eventually. So Yapi, for example, in Panama has launched a specific portal, a specific service for entrepreneurs or empresarios. When you reach a certain threshold, now you start to pay some fees. And at that point, the company is starting to understand, hey, this digitizing is actually good for my business. It brings me efficiencies and it benefits me in the long term. So, those making it as free and easy as possible in the short term, and then adding value over time as the company matures has been a winning equation so far.
Okay.
One last thought on that is in the Caribbean. Now, many banks don't want to get into this game because they don't see it as profitable, but this is a long-term play. And in the Caribbean, where you don't have a lot of these local fintechs or a movement from the central bank, it's really the opportunity and the responsibility of the banks to enable this. And so that's the final thing I would say about the Caribbean or any small market.
All right, excellent. Thanks so much. We have another question from Javiera that's more in the area of Diego, I would expect. Her question is, it is said that in the last decade, it was a lost opportunity for infrastructure development in Latin America. So she's asking, which country now has the biggest logistics infrastructure necessities?
Abel, I wouldn't focus only on one country, but when I remember my remarks about nearshoring and the great opportunities that we are about to experience in the next 5 years, I believe Central America is the first region in Latin America that comes to my mind, because countries like Guatemala, Honduras, El Salvador, even Costa Rica, they have tremendous opportunities to tap into the nearshoring as we think about the textile sector, even bringing smaller tier 2, even tier 3 producers to be incorporated in the global supply chains, specifically in the Mexican supply chains that serve the US market. I believe that in terms of infrastructure, Central America is way behind. And unfortunately, that will be one of the greatest obstacles that these countries will face in terms of piggyback on this great opportunity. Also, the Caribbean, it has tremendous opportunities in terms of becoming a hub for break and bulk cargo, for transshipments, considering the bottlenecks that we faced during the pandemic. I think those two regions are way behind in terms of what they need to invest.
All right, thanks so much. So we have another question from Milton. This one is focused on specific energy markets. So here he's asking if we can elaborate on the outlook for a couple of energy markets. He mentions Guyana and Venezuela. So Arthur, I'm not sure if you'd be able to tackle that one.
Sure. Yeah, Guyana, for those that have been following, is one of the best stories in energy markets in the past couple of decades. They've found over 11 billion barrels of oil, and should be producing around 1 million barrels per day by 2027. So they're going to go from one of the lowest GDP per capita in Latin America to one of the highest in the world. So very impressive growth there. There's definitely challenges. It's a very small country that's very politicized and polarized in terms of ethnic and racial tensions. So you have to be, well aligned with the party, both the party in power and the party that's opposing, because that once that changes, all your contacts within that administration will be irrelevant. So very tricky situation there. There's a very strict local content law as well. But we do see a massive opportunity for growth with the right strategy in Guyana. Venezuela, as many of you know, has been quite a declining story in several years, but there is sort of a opening in the last couple of months. We saw, I think just today, Biden was mentioning that there's possibility of eliminating some of the sanctions if Venezuela moves towards free and fair elections in 2024. The likelihood of that happening, I still think, is pretty low. I don't see Maduro really offering an opportunity for the opposition to be elected, a real opportunity. So the sanctions that will be lifted will be very limited to get crude from Venezuela into European hands to pay back debt owed from PDVSA. I don't see a wide opening of sanctions that would lead to massive opportunities. And for example, gas from Venezuela going to Trinidad and Tobago to revive that industry. We don't see that happening in the short to midterm. But overall, if we're looking in the past 5 years, there is a bit of a upward trend in the Venezuelan hydrocarbon sector.
All right, thanks so much. So shifting gears now to mining, we have a question from Norman. And the question is, are there any comments regarding the risks around nationalization of mineral assets and how that will influence investor confidence? I thought Alejandro might be a good one to answer that. And in particular, by the way, Norman is thinking about lithium in terms of this question and the mineral assets.
Yeah, thank you, Abel, and thank you, Norman, for your question. Lithium was recently nationalized in Mexico, so that is a very important signal for the market as a whole. There are questions based on that decision on whether the Mexican government is going to be able to compete at a regional or local or global level, because lithium mining has very high technical requirements and financial requirements, and the Mexican state has proven itself to be not the most efficient manager on the past, based on experiences in oil and other industries. So definitely this event has hurt investor confidence in Mexico, not just in the mineral sector, but in all other industries. In Latin America in general, we are seeing some discussion about mineral nationalization. There were discussions to that effect during the Chile Constitutional Assembly, where there were proposals to nationalize several key mineral assets. And that did not bear fruit. And I think investors in general found that to be a relief, and perhaps compounded with the rejection of the proposed constitution. Miners are now renewing their interest in mining in Chile and the Chilean economy in general, in spite of the tough macroeconomic and political circumstances that they are facing. But the risk of nationalization is prevalent across the region. It comes and goes. Sometimes governments want to capitalize on their campaign promises or public trends in order to attack a specific industry and benefit from sky-high mineral prices. We saw something to that effect in Peru. We are seeing something to that effect in Colombia, although it has not translated directly into nationalization yet. But it is definitely something that is ever present and that is always in investors' minds when considering bringing their money to Latin American mining and mineral investment.
All right, thanks so much, Alejandro. Now we have a bit of a broader question that came from one of our anonymous attendees. And that question is, which specific reforms do you believe have been driving investment and demand in Brazil?
Let me take a shot at starting that, and then I'll ask Arthur to help me out with some of the energy stuff. But certainly the pension reform in Brazil was important because the heavy burden of pensions fiscally in Brazil have always crowded the capital markets. Government has basically sucked all the money out of the banking system, which has kept interest rates very high. And so pension reform allowed the government to lower its obligations, stretch out over a longer period of time, its ability to sustain deficits, et cetera. And that just helped bring down interest rates. And we saw a massive influx of Brazilian savings that were kept offshore back into Brazil. And I think that spurred a lot of investment. We've also seen certainly some reforms that might be changed around widening the territories where mining and energy can be pursued that were environmentally controversial, but certainly opened up opportunities in some of the more frontier areas of Brazil. We've seen some changes to labor code, which allowed, again, for companies to more aggressively hire people, which has been positive for Brazil. We've seen privatizations in things like airports. And of course, we've seen privatizations in the energy sector, as well as the opening up of the renewable sector. And maybe, Arthur, you can elaborate a little bit more on those areas.
Yeah, sure. Brazil is in a very difficult spot right now. And speaking of family members, they say it's the most polarized election they've seen ever. So it's a very contentious and somewhat violent spot that Brazil is in. And even though Bolsonaro did much better than expected in the first round of the elections, Lula is still the clear front runner for the second round in the end of October. In terms of energy reforms, yes, there was a privatization of Eletrobras, which means new assets for sale from generation to distribution all along the value chain. That's going to be very good to bring in new investment from private players. There was the opening of the gas sector. So there was a monopoly held by Petrobras. Now it's opening up to private players, not only in terms of generation of gas, but also the transportation and distribution of gas. And then also finally, there's been a new policy to incentivize distributed generation, as I've mentioned. Those subsidies end by the end of this year. So there's been a massive influx to get approval for those projects before these subsidies expire. But even once those subsidies expire at the end of this year, we do expect distributed generation to remain competitive in most states within Brazil. So several different reforms, all with the focus of opening the market and bringing private players into the energy sector.
All right, thanks so much. Well, Rodrigo has a bit of a broader question for us, and I think this might be good for Lindsay, considering her work in this area. And his question is, what are the trends for business models that address key social issues such as poverty, inequality, and inclusion?
Great, thanks for the question, Rodrigo. Now, it really depends on what you mean by poverty, inequality, and inclusion, because that's a word that can have many definitions. If we're talking about true poverty, there actually aren't that many new business models catering to the poor. There are a few, pilot programs and initiatives that target, providing credit to farmers, or credit to, female entrepreneurs in rural areas, or assistance programs or income generation programs for communities that are isolated or truly, lacking in terms of financial resources. That still is kind of a philanthropic mission whenever something is deployed. However, there we've seen massive innovation and efforts to help the underserved, who may or may not be struggling financially, but who are somewhat excluded from the formal economy, are operating in the informal economy, and that by nature is subject to, any volatility is going to impact them the most, any recession is going to impact them the most, any pandemic is going to impact them the most, and so they are in a vulnerable state. So some of the business models that we've seen be successful or really go after this segment are marketplace models, and any technology that is helping small business and individuals sell online through marketplaces like Mercado Libre, platforms that can help you easily set up a website like Shopify, and instant payment or payment link type of technologies that enable you to easily accept a payment cheaply and instantly. You don't need a website, you don't need a developer team, you don't need to make big investments. You can immediately start selling online. And overcoming poverty and inequality is about income generation. So anything that's helping individuals or companies make more money or get access to capital is going to help with that. Access to credit is another one. Reducing the barriers to access to credit through, next generation small business lenders, personal lenders like Creditas in Brazil, who are innovating in providing more accessible payroll loans and personal loans. And of course, buy now, pay later, which is making products of all kinds more affordable to consumers. And then the last thing I would mention is technologies that are enabling Latin Americans to make money in new, non-traditional ways. This is the gig economy, which has already been around for 10 years, but more recently, gaming, earn-to-play gaming opportunities, crypto, gambling. Now, these are kind of like very high-risk activities, but they're attracting people who want to make money in non-traditional ways. Also, the influencer economy and the creator economy, where I can go online, I can create content and make money in a variety of new ways that didn't exist even 2 years ago. That's being enabled by mostly international technology platforms like YouTube or TikTok, and then payouts, the ability to move money in small amounts and quickly to recipients and to influencers is bolstering. These are going to be more like middle of the pyramid young people, but it's creating a whole new kind of alternative economy that didn't exist even 2 years ago.
All right, thanks so much. So we have another one from Richard. This is kind of an interesting question. What is the panel's view on the political powder keg that is Brazil?
Happy to take that on. Richard, good to hear from you. It was really interesting. The day after the first round of elections, the Bovespa jumped 5.5%, and markets were generally quite giddy at the idea that not so much that Bolsonaro might win, but that pro-business Congress was elected or reelected. In other words, if Lula wins, which most people expect he will, he'll be lording over a Congress that does not want to undo the reforms that were taken on in Brazil, wants to follow a fiscally prudent path, etc. But the fact is that analysts have been talking about a scenario where Bolsonaro narrowly loses the second round. And the fact that he ended up only 5 points behind Lula, I think was a little bit surprising. It was, I think the polls were predicting a 7-point difference, and it ended up at 5 points. So depending upon, we had, I think, about 18% who filled out either an empty ballot or were disqualified with their ballot. Typically in a second round, that goes up even more. So because the the candidates that they might vote for are off the ballot, and now it's down to 2. So we're going to have empty ballots maybe of 25%. We're going to have some of the people who voted for other candidates shifting to either Lula or Bolsonaro. And if Bolsonaro ends up losing by, say, less than 1%, he may very well call foul. He certainly has threatened to do so. And that is what worries people. And I think that's what's really embedded in Richard's question of a powder keg. I think that a lot of people are old enough to remember Brazil and the military juntas of the past, and they worry about Bolsonaro's close relationship with the military. I think that if Bolsonaro sort of called on the military to intervene, they wouldn't respond, or at least enough of them wouldn't respond that it would pose a threat. I think that Brazil's military is both independent and politically respectful of the chain of command. So I don't see that happening, but I do see potentially, in a very close race, reasons for recounts and a few weeks of uncertainty until we arrive at a result. I mean, it happened in Mexico years ago when AMLO lost to Calderon. We had 5 months of waiting for the Supreme Court finally to reach in. I don't think that'll happen in Brazil, but we could certainly have a couple of weeks of uncertainty there. That's certainly a scenario that's out there. I will put it at about 20% likelihood. I think the 80% likelihood is that Lula will clearly win second round.
All right. Thanks so much, John. Well, we have just a couple of questions left, so we figure we might as well take care of those before we depart. One is from Jeremy, and it's very much focused on the energy sector. So his question, and related to sustainability, which we talked about earlier, of course. So his question is, as banks have to comply with Paris alignment agreements that center around channeling funding to climate sustainable or climate mitigation purposes, do you see funding crunches on the horizon for traditional industries? And that would force these industries to refocus on green-friendly investments. And do you foresee this to be net positive or net negative for LATAM? So there's a lot to unpack there, Arthur.
Yeah, thank you for the question, Jeremy. So I don't think the struggle with accessing capital is going to come from so much of a sustainability angle, but more of a higher cost of capital led by higher interest rates. I think that's and a looming recession, global looming recession. I think that's really what's going to drive the capital, the liquidity crunch in the next couple of years. When we look at traditional industries, so think mining, etc., those industries are actually moving towards greener measures faster than others because they have had so much scrutinization over their methods, and they often emit a lot of CO2. So you actually see a lot of these mining projects and companies implementing green, renewable energy for their mines, lower emissions for their vehicles faster than some other industries. So that's something to know. I don't think that there's going to be I don't think there's going to be a capital crunch for traditional industries related to sustainability. If anything, it's going to be because of a looming recession and higher capital costs because of interest rates.
All right, thanks so much. So we have a final question here from Jaime. This is for Lindsay. He's asking, Lindsay, can you expand more on ways that the digital shift has helped explode the adoption of niche consumer good brands, particularly those from the United States? You have an example of a consumer brand who really captured this opportunity during the last few years and did it well as a best case example.
Great question, Jaime. I love the question because it speaks a little bit to what we were saying earlier in the webinar, in which this digital access that has been broadened gives brands access to new consumer groups and the ability to compete for very niche segments of the market. Now, thinking about some best case examples off the top of my head, I would, the first one that comes to mind is not from the US, but it is from Asia, Shopee, a marketplace from Singapore that has, within 2 years that it kind of came on the radar in Latin America, has become almost overnight one of the top 10 e-commerce sites in Brazil. competing with massively successful local players. And they were able to do that from Asia in a cross-border fashion, thanks to cross-border payment enablers that have made this possible for foreign brands to come in and just really have outstanding results in Latin America. It showcases kind of the opportunity that is kind of hiding when you have the right product. And I think they've done that because of low-cost goods and product variety that's simply not available locally, as well as improvements in logistics that have made this now that feasible and viable. Another example that comes to mind is Disney. Well, first it was Netflix who had early success. But when we're speaking about niche, right? Disney had recently announced that they have more global users than Netflix. And this hasn't happened in Latin America yet, but Disney is having really great success in Mexico and Brazil and elsewhere, targeting kids. And kids' parents of kids who want good content for their children, especially during the pandemic. So, and another along those lines of targeting young people, several gaming platforms. The one that most comes to mind is Free Fire from Garima, based in Vietnam. I was just in Guatemala last week, and trying to learn about the ecosystem and digital behaviors of consumers, and gaming in particular is very interesting in Guatemala. Everyone I spoke with kind of was curious about this opportunity, and Free Fire being the number one platform, and it's been successful because it's a great experience in a kind of low, I don't want to say low quality, but cheaper smartphone. You don't need a desktop, you don't need a high resolution, high memory phone to play this game and play it well. And so of course that is going to be appealing to middle and lower income consumers who are now digitized, want to participate, and particularly to young people. So I love the question. There's I'm sure many other niche opportunities, even more niche than those examples. And that's part of what this kind of digital disruption trend is enabling.
All right. Thanks so much, Lindsay. Well, I think that does it for all of our questions. We certainly went over time a bit, so we're going to wrap it up for now. We want to thank all of you who are still with us at this point in time, and everyone who attended. Thank you so much. We hope that you found our insights to be helpful, and we certainly hope that we can continue the conversation. Our contact information has been shared earlier, and of course we share some of our other content, so we hope that you can reach out if you have any other further questions for our panelists, and let's keep the conversation going. Thank you so much, and we hope that 2023 and the coming decade treats you well. Thank you. Have a great day.